Hello, everyone, and welcome to today's episode of our 7 Investing podcast. I'm 7 Investing founder and CEO Simon Erickson, and our mission at 7 Investing is to empower you to invest in your future. There are a lot of headlines going on out there right now. There's a lot of doom and gloom in the market. Just today, we saw that inflation's at a 40-year high. There's a lot that's probably going through your investing mind, but perhaps it's a great time today to look back at fundamentals. And there's some stability that can cure this rocking ship, and it's called looking at the actual performance of companies, looking at their financial statements, and make long-term objective decisions based upon that. As such, I'm really excited to welcome Dillon Valdez to our program today. He's our guest. He's an individual investor, does medical sales as a full-time job, but has really embraced investing, especially from a long-term perspective. In addition, as a great supplement to the income that he's got. Dillon, hey, thanks for joining me on the 7 Investing podcast this afternoon.
Hey, Simon, thanks for having me here today. Really, it's a big honor to be a part of your podcast.
Well, Dillon, we're going to jump into the financial statement piece in a little bit and kind of things that you look for when you're sizing up a company and making investment decisions. And even later on, we're going to talk about a couple of stocks that you actually are very interested in, but maybe it's best to kind of frame this. Can you tell me a little bit about your background and kind of the approach that you take to investing?
Yeah, I really like this. So when you think about me, right, I don't know exactly how I ended up getting the following I did, truthfully. I think I just really like to post about stocks, but I am an independent investor, right? And I do have a business background. So I've always been a lot more focused on the business and the business fundamentals, even before I was even a stock picker in itself. So brief background, right? So I have a business management degree. So I haven't just a BS. I'm not an MBA. I'm not a PhD or anything like that. But I ended up being a part of a company called Gartner, where I really learned a lot about, and I'm ticker symbol IT, right? So where I really learned a lot about the business and the business function because of how our sales process was. And that's really what laid the framework. It's always weird that you look back and the dots always connect, but that's where I ended up receiving my framework for how the business operates and the importance of cash within that business model. So, and then over time, I know that I ended up finding a passion for both, software and medical sales, but medical sales, I believe it's a better fit. But that's when I ended up encountering the opportunity here, right? Where you start getting a little bit more of disposable income. So you start asking yourself, what am I going to do with it, right? So I think that this is really important and a thing that a lot of millennials ask themselves there today, right? So if they do have $200-300 extra dollars, what are they going to do? Are they going to buy a new truck? Or are they going to buy a new vehicle? Are they going to buy a new couch? Or are they going to finance this or finance that? Or are they going to try to invest into the future? And a lot of us, we don't necessarily have that same opportunity to put it into a savings account, to buy government bonds, because even after the yield or the bonds have been quote unquote selling off, right? But the yields have gone up, it's still going to be below inflation expectations. So for us as investors, we have to think to ourselves, like, what are the assets that we can actually invest into and not just speculate? And for me, I really find 2 different avenues for that. And that's going to be real estate and stock picking. Yes, we could. I think that majority of investors could realistically put their money into the S&P 500 and do very well, because historically the S&P 500 has been an inflation hedge. But for me, I know that because of the business background and because of how I focus so strongly on the financial statements and really get that full picture of the business model through the financial statements, that I can really pick stocks effectively. And I do think that, especially within today, right? So we ended up, I think the Nasdaq is down 15% year to date. It's probably going to hit 20% again here. And you ask yourself, and I believe that a lot of investors are asking themselves, like, which companies can I actually pick that are going to go back up long term, right? And that's really where you find so much clarity in these financial statements and running through them effectively to actually get that picture that you're looking for in the business and build that conviction. And it really has everything to do with cash and cash flow. So that's what I'm really excited to talk about here today.
Absolutely. Well, Dillon, let's jump into that in a minute. Just a reminder that anyone that does want to follow Dillon, he posts quite a bit on stocks. That's actually how I found him, was on Twitter. He's at Blue Suit Dillon. Blue is BLU, Suit, and then Dillon, DILLON. I encourage everybody to follow him. He's posted some fantastic things for several years now. And that's kind of how I met with you in the first place, Dillon. Speaking of Gardner, Gardner also takes a very realistic approach to speculation in the stock market, right? A lot of people might be familiar already with the hype cycle that gets published all the time. There's more to investing in stocks than just kind of seeing something that's exciting and has a lot of momentum. I think a lot of times retail investors follow that, but there's definitely an underlying business in any company that you're buying into. And you mentioned financial statements, and cash flows is a great way to objectively evaluate that. Tell me a little bit about how you look at financial statements and how that influences your investing process.
Well, it really comes down to when you make things really simple. So you ask yourself, why do stocks go up in the stock market, right? And why do we always see those little tick upwards and tick downwards? And it really, in my opinion, this is just a theory that I have, right? Is that, and I think that we can probably agree on this, that all stocks move based upon future earnings expectations, right? So if that's going to be the realistic thing that pushes the American stock market up intrinsically over time, then we must be asking ourselves, what are the things that we're going to be looking at that support the thesis of earnings growth over time? And that's with both the S&P 500 on a macro perspective, and then even on a micro perspective, the individual businesses that we're actually end up picking. So during periods of really turbulent times in the macro environment like today, when you have like inflation and when you have recession fears and you have war and you have all sorts of macroeconomic instability factors that could potentially impact the future earnings and the earnings expectations of these businesses, you have to narrow down and focus on a couple key details to these businesses. Number one, are they recession proof, right? And you start asking yourself, like, what's the durability of the business model? And that's where I really find a lot of those software stocks that do have those, they do have contracts, and they typically have like 1, 2, 3, 4, and even 5-year contracts, like Datadog, right? So they end up actually giving these contracts to their customers. Their customers are required by law to pay these, which creates a stickiness to the business. And then when you really narrow things down specifically, remember the overall objective here is to find a company that has earnings or has a high likelihood of future earnings within the very near future at the very least, right? Otherwise, you start becoming too speculative. So when you really look at that income statement, there's a couple key things to really look for specifically, like that gross margin, the operating margin, and even EBITDA, right? And you ask yourself, like, what do those actually mean? Well, if you take a look at just that, like every dollar a business spends, if they have like a 70% or 80% gross margin, that's like them keeping 70 or 80 cents of every single dollar that they make. And then I like to think of it as like a rule of thumb that the better the company is better, the furthermore you can go down the balance sheet and start valuing the business based upon that income statement, right? So you got gross profit margin, and then you have operating margin, and then you even have something like EBITDA, right? And EBITDA and operating margin are relatively similar, but there's all sorts of different tax deductions. I feel like I can talk about this forever, right? But the objective of this is to really find a company that can produce earnings effectively, or is at least trending towards it. So I think one company I can talk about specifically is going to be SentinelOne, right? I own that stock, but they're currently unprofitable. And a lot of people would say, well, Dillon, why would you own that stock? And that has everything to do with the fact that they're actually within 2 years of break even as far as the operating cash flow goes. So when you use the income statement with the cash flow statement, this is typically when you can reconcile both of them. Sorry, I'm just hiccuping here. Where you can actually reconcile both of them, right? So you can take a look at their operating margin, but then if you look over the cash flow statement, if they have a positive operating cash flow, that essentially means that they're trying to reduce the amount of realized, quote unquote, income to write that off in taxes, so they don't have to pay taxes on that net income. So that business is operating profitably, right? But you got to look at those cash flow statements to justify that investment thesis. So every single stock I have they have operating cash flow break even or positive, or are projected to at least, right? So then when you take a look at SentinelOne, they don't have positive operating margin and they don't have positive operating cash flow. But when you take a look at the trends and how fast the trends are moving, you can actually see that they're projected to be positive here. They're trending towards EBITDA break even or positive very, very quickly, right? And their gross margins is expanding as well. And then you can even take a look at a lot of other companies like Datadog or like DLocal or like GLBE. Like these are all hyper growth companies, but they don't need to be speculative, right? So essentially, I really try to focus on these hyper growth companies that are growing profitably. And that really destroys any sort of thesis that you have towards these otherwise known as like value investors, right? Where they're always saying like, oh, you invest into growth stocks because you should be thinking to yourself like, hey, are they operating profitably? Are they not operating profitably? But they are. So they actually have it's called non-GAAP, right? So non-generally accepted accounting principle. They have earnings and they're growing 50, 60, 70, 80, 90% a year. And even in economic slowdown, like Datadog is still projected to grow over 50% this year. DLocal is projected to grow well over 50% this year. GLBE is expected to grow 70% this year, and all three of those. And then you got other companies like Zscaler, and then you have like Silvergate Capital that's also expected to grow. And I mean, the list goes on and on about all these stocks that I do own, and every single one of them are operating profitably with over 50% growth in an economic slowdown, right? So let me circle this back here. When you come down to the stock picking process, when you look at companies, like when you look at the macro environment, it can be cloudy, right? And it's very cloudy right now, and it's raining outside. And this is very difficult for a lot of retail investors and a lot of individual investors to really focus on the idea and the objective of long-term investing. And they don't always know what good looks like. Like, what are we actually supposed to do? But there's businesses that are out there, and that's essentially what I focus all my research on. There's individual businesses out there that are still growing despite the macroeconomic environment, and they're growing profitably as well. These are superior businesses, superior business models, and then their management teams are operating these companies extraordinarily efficient.
There's a ton of great points in that. I want to make sure that I just double back and circle a couple of them that you made there, Dillon, that, we've been in basically a 14-year bull market, right? And it's made a lot of companies look good. You kind of have to go back to 2008, the last time that we had a serious recession in this country, to really see what tested companies. But now we're getting hit. We're getting slammed pretty hard. 2021 and 2022 has certainly taken a toll on a lot of those growth companies that were getting a lot of love from the market in the middle of when times were fantastic. And now it's kind of the testament, the judgment day for a lot of them of who can endure. And I think that the points that you make, which is who is recession proof, who's got these sticky contracts that are long-term with their customers, and who's growing profitably, not just top line revenue growth, but who's showing the operating margins, the EBITDAs, even in the last quarter or 2 or 3 quarters, that's kind of built to endure, the tough times like this. Is that a fair recap of kind of your strategy and the specific metrics you look for? Anything on the balance sheet too that you wanted to include along with the cash flow statements or the income statements that you're looking for?
Absolutely. I think balance sheet is probably one of the most important things, because so what I like to think about it as is that the balance sheet is the otherwise known as like health report of the business. So if you go to the doctor and you get that physical, and then if the doctor comes back and says, well, guess what today, Simon, you have high blood pressure, right? And then you get all sorts of, right? We invest, right? But that's essentially like the health report of the business, and it really gives you a good understanding of how durable is the business going to be during times of economic uncertainty. So there's a couple businesses that I can really point out here. Snowflake has an A+++ balance sheet. They got I think it's either $4 billion or $6 billion in cash and cash equivalents, and 0 debt, right? That means that company is, so not only are they growing through this economic uncertainty, and they're growing exponentially at like 80 or 90%, but they also have this really durable balance sheet that they can realistically operate on. Like they don't even need to grow, and they're going to be operating cash flow positive here pretty soon. But if there's any sort of like economic turbulence, like let's say maybe the growth comes in a little bit lower than expected, maybe interest rates go up to 6%. Snowflake is virtually unaffected by that in every way because they don't need to raise any more capital, right? So like when you find those companies, finding a company that has a strong cash position, remember, it's all about the cash in the business, right? strong cash position, and then a low debt position. Now, there is a difference between current debt and long-term debt. Current debt usually needs to be repaid within 12 months and could potentially be a little bit more higher interest. Where long-term debt, that could be that's like the perfect thing that retail investors use is this long-term debt, which typically has a lower interest and can be used to buy assets, like otherwise known as like property, or it could be commercial buildings or whatever it might end up being. It could even be like another business, and they could use debt to funnel that purchase of the business. But as long as the business is operating and growing profitably, then that would be an otherwise known as like good investment, right? But the number one thing that I hate about having companies with extreme amounts of debt, so like there's a couple balance sheets that I've looked at, like Ford is, and this is why I'm not a value investor, is because I have a difficult time looking at these balance sheets and justifying the investment thesis when it looks like that they're never, ever, ever going to be free from debt in any way, shape, or form. That's going to cut into the returns that we end up getting as investors, right? And then even like Datadog, I think that, so they are incredibly profitable. They are a cash flow machine, like operating cash flow and free cash flow. So they're just producing copious amounts of cash, but they still have that $700 billion in debt on their balance sheet. And that typically is, to me as an investor, says, okay, what I'd like to see is that to not get any worse than it is right now. I know you guys are operating really profitably right now. Maybe pay some of that back, because the way that I like to look at debt is that it's a way for the business to borrow from themselves in the future. Just like for us as individuals, right? When we use a credit card, every time we swipe a credit card and we actually cannot pay our credit card back within the next, couple days or a couple weeks, whatever it might end up being, we're borrowing from ourselves from the future. Well, when you start borrowing from yourself in the future, the more you borrow from yourself in the future, the worse it looks, right? And that's the way that I like to look at debt. It doesn't even matter, because I know that even in corporate finance 101, you can say is, well, it doesn't matter because the cost of debt is cheap, especially when you can service it. And you got to pick between, raising corporate equity raising or selling equity, or actually having this extracting debt because the cost of capital is going to be whatever, right? It still looks the same to me, because you still have that gap earnings at the end of the day, right? You're still affected by that interest rate, and you're still going to be strapped later on down the road. So in times of economic uncertainty, just like how I ended up mentioning, like Snowflake has an A+ balance sheet, Palantir is the same way. They got like $2 or $2.5 billion in cash, no debt. But when you see companies, they have large amounts of debt. Like I think a lot of the value companies have massive piles of debt, but when the interest rate goes up, and they've been buying back stocks, so essentially leveraging their balance sheet up, so they've been taking out long-term debt to buy back stock. This doesn't seem like, sure, Wall Street might like this, but as a long-term investor, is this really where I want to put my capital? If I'm going to be investing for the next 5, 10, 15 years, what happens if this company, like what happens if interest rates do start to go into, like maybe the secular bull market in bonds is done, right? Maybe the structural changes end up happening in our economy enough to actually support higher interest rates for a sustainable period of time. There's all sorts of different factors that you can think to yourself that debt probably isn't going to be one of the best things. And I always look at that and, making sure the rule of my general rule here is that they got to have enough cash on their balance sheet in order to pay it off. And so I know that MercadoLibre is going to be one of the favorite ones out there, right?
Mm-hmm.
And MercadoLibre, they're profitable. They're expected to grow earnings 100% year over year for the next 2 or 3 years. So that's an amazing company, right? And I think that they're projected for 30 or 40% growth over the next 3 years, but they still have a large pile of debt. And that's a big reason why I don't actually own them. I have owned them, and I ended up having a quick little, it wasn't meant to be a trade, but I just moved my capital. I bought it at $800 something, $880, and I sold it at $1,200, and I allocated more capital to a lot more of my higher conviction stocks. But in that particular case, it's a great company. It has everything that I'm looking for. It has that durable it has that durable moat. They may be cyclically exposed to some economic risk, to some, not a lot, because they are just like the main player there. But they do have a little bit more debt than I'd like on their balance sheet. So that is essentially where I really make a lot of investment thesis is that at the end of the day, the only thing that matters is the business growing revenue, is the business growing earnings, and is the business growing and managing their capital efficiently? Like, are they generating cash? Because that's the intrinsic value of the business. The intrinsic value of the business, as defined by Warren Buffett, is their expected future cash flows over time, like the discounted cash flow model. So that would be the intrinsic value, right? And that's the way I really look at a lot of these businesses and make a lot of my investment choices.
We'll chat about those investment choices in just a minute, Dillon. Just to avoid overly simplifying this, but to kind of condense it down, it sounds like you're really a fan of organic, profitable growth. Stay away from financial shenanigans, and certainly you don't want to invest in any company that's got too much debt on their balance sheet. Fair assessment of your investing style, if not oversimplified there?
I think that you're spot on.
Okay. Fair enough. Well, let's talk about a couple of those companies. We had three that we wanted to chat about. A couple of them we've kind of mentioned here a little bit earlier on the program, but the first one was Datadog. That's DDOG for anyone who wants to follow that. You called it a cash flow generating machine.
Yeah.
Tell me a little bit about what you like about this company.
So it's not just this company. It's like a lot of the companies that I go through and I pick, right? It really has a lot to do with cyclical and secular forces, right? And I think that this is way too often overlooked. So it's like, what is a cyclical force in the economy? Well, this is something that is going to be prone to the economic booms and busts. So the way I like to look at it is that over time, there's massive waves, and that's exactly what they look like, is that there's going to be cyclical waves where they're a lot smaller in time frame, and then there's secular waves where there's going to be a lot more. It's essentially the market cycle, right? There's a bunch of little market cycles, and then there's one big market cycle called the credit cycle. Well, whenever I'm trying to look at these my potential investments, I'm looking at the ones that are grasping that secular growth, right? So like the ones that are the e-commerce players, the ones that are going to be the software players, and in Datadog's in Datadog's niche, it's going to actually be application monitoring for a lot of these companies. So essentially what they do is they allow companies to monitor their applications and even provide a security component to it. And then then from there, you think to yourself, okay, well, knowing what I know about the businesses and thinking about the tech stack, do I think that a lot of these applications are going to grow over time? And what is the value behind that as well? And then you could even look at the Gartner Magic Quadrant to see where they fall in relation to their competitors. And then what really got me with Datadog. So I knew Datadog was a cash flow machine. I knew that it was growing really quick, but the only thing that really got me was actually on this latest earnings report. So all of their competitors like Dynatrace, and then I believe Splunk is another one of their big competitors. They actually showed a decline in revenue growth, but Datadog showed an acceleration. So you don't always need to know, and this is what I think a lot of investors overcomplicate sometimes, is like, and I see a lot of technical people do this, where they really focus so much on the tech, right? They say the tech does this and the tech does that, and I like the tech more, therefore I can build my investment thesis on top of that. But the thing is that at the end of the day, tech is one component to the business model, right? You got sales and you got marketing. So that means that, like Snowflake, for example, has an amazing sales and marketing team, which is why they continue to grow. And Datadog is an extraordinary, they just execute on all levels. They're executing new products, so they're really doing great with the product development. So they're even developing new products over time. And they're selling their product efficiently, which is essentially creating this accelerated revenue growth and accelerated earnings growth and cash flow growth. So it's like, when you think to yourself, okay, what do I like about Datadog? I like the fact that they're catching the secular growth trend of application monitoring, right? And cloud computing. And then why do I like it even more on top of that? Because they got a great balance sheet. They have more cash than they do debt. I think they have like 1.1 or 1.2 billion dollars of cash, and then 700 or 800 million dollars, definitely, of long-term debt and very little current debt. And then they're cash flow positive. I think that their cash flow margins, like their free cash flow, is like 24% or 22%.
Very high. Fantastic.
Yes. Which basically means that you don't even need to care about that debt really, because it's just a cash flow machine. So when you take all three of those components, like, is it catching a secular growth trend? Yes. Does that secular growth trend, is it prone to the cyclical economic booms and busts? Not really, right? And then do they have a strong cash position? Yes. Are they growing? Yes. And how about their operating and free cash flow margins? And if all of those turn out really great, then it seems like that would increase your odds of success when you're stock picking.
Let's talk about another one of those secular growth trends, because you mentioned e-commerce in there. That's something that's certainly catching on internationally, Dillon. You mentioned DLocal and GLBE, which are both kind of tangential to this space, right?
Yep. So I can actually talk about both of these interchangeably, and I'll talk briefly about their business model and what makes them unique. And then even talk about like the markets that they're going after, and then briefly about their financial statements. So let's talk about GLBE. So the growth story around this one, I think is, and it's actually one of my largest positions, and I really, really like GLBE. So they're an Israeli company, and they just came on everybody's radar. I think that they IPO'd at like 24, 25 bucks a share. They're currently trading at about 30 or 31 right now, obviously because of the growth stock sell-off. And what ended up happening when they IPO'd is that Shopify actually took a vested interest within GLBE. They originally purchased about 5%, but now they ended up, I think that they exercised the options, or not options, but warrants to buy a larger portion of GLBE, and now they own about 10%. So roughly in that area. Don't quote me on exactly that 10%. It's probably somewhere up there.
That is ballpark, yep.
Yep. So GLBE, what they do specifically is, remember once, like I mentioned with Datadog, you think about the secular growth trend. And in this particular case, it's international e-commerce, right? When you look forward and you look into your future, like what do you think that international e-commerce is going to be a relevant theme moving forward for the next 5, 10, 15 years? And in this particular case, in both DLocal and GLBE's case, cross-border e-commerce, because that's exactly what both of them do, right? So GLBE, what they actually do is they help out e-commerce partners like Nike or like Netflix and other vendors like that. And what they do is they actually close the gap on these borders. So so a player in the United States, like Nike, like I ended up mentioning before, there's all sorts of complexities that they might end up having if they want to sell to a different market, right? So if they wanted to sell to like France, or if they wanted to sell to Singapore, or if they wanted to sell to Japan, there's a lot of complexities that go on into that, which include regulation, currency exchange, marketing, local language barriers. So they would have to hire out a whole different team, right? And that's expensive for that company. Otherwise, the alternative to that is going to be GLBE. And they're the dominant player in this space. So you can either partner with GLBE, or you can hire your own sales team to try to do these international e-commerce efforts. So GLBE, they're actually helping out. And then you can even look at their customer testimonial stories. A lot of these customers, they're having like well over 100% year over year revenue growth on an international basis. So international revenue growth. And then when you narrow it down, you know, they're operating cash flow positive. I think that they have free cash flow, and they're growing 70%. And what makes it even a stronger thesis of mine is that 10% ownership in Shopify, they are actually being given clients. Shopify's largest clients are transferring on over to the GLBE's platform. So this is going to be a growth engine for the next 1, 2, 3 years, is Shopify's partners, just Shopify's partners, and then everybody else after that. So, and then they're just a tiny little company right now too, like a $4 billion company. And then DLocal, so they're going to be a lot like, I think you pronounced the name Adyen. Does that sound about right?
European, yeah, financier, yep. Right? The payment processor.
Yep. So you got Adyen, and then over there in Europe, and then you have Nuvei in Canada, and then you're going to have Stripe in the Americas, or North America specifically, United States. And all of these companies, and DLocal, and all these companies have a very similar model, and in the sense that they're providing payment infrastructure. So I don't actually own Adyen. I don't own Nuvei, and obviously we can't own Stripe in the public markets, but I chose DLocal for one specific reason, is that they specialize in emerging markets. And 1 second here, I got to get some water. I've been talking so much.
We'll give you a breather there, Dillon.
Yeah. So
I commend you for drinking water, not coffee, which is my go-to all the time. Probably too much caffeine for my own sake.
Yeah. So DLocal, them specializing in emerging markets, this provides very, very unique growth opportunity. And the reason why that they do this is that they do partner, and you can actually look at their clients. They partner with Microsoft. they're partnered with Amazon, and they're partnered with like DD, the ride hailing network, and a lot of these other major players, right? So these major companies are picking DLocal for a reason. So their customer base is one part of that thesis. And then you think to yourself, okay, they're specializing in emerging markets, which is specifically LATAM, and then even like Asia Pacific. So yeah, C is over there, but let me break these things up here real quick. When we're talking about payment infrastructure, what we're talking about specifically is from a commerce perspective, not e-commerce, commerce. So all transactional flows in and out of that company or out of that country. So that's why you end up having these two different categories of this payment infrastructure, pay-ins and payouts. So pay-ins is essentially when the consumer, so like, let's just run this scenario here. Let's say a consumer, so they're from Uruguay. So let's say somebody wants to do business in Uruguay. Amazon wants to do business in Uruguay. Amazon can host their platform over there in their e-commerce website in Uruguay. And somebody from Uruguay can go onto Amazon and buy something on Amazon.com. And then that is essentially going to be a pay-in, right? So that goes up to the company. And then when you think about DD's perspective, which is basically the Uber of China, this is going to be the best example. So like, let's say DD wants to come over to Uruguay again, and they want to host their ride hailing solutions there. They want to host their platform there. So then when somebody goes into the DD driver, essentially what they can do is that they can pay the driver, or they can pay on their app. That's going to be the pay-in, right? That goes up to DD. But now DD needs to pay that driver. That's going to be a pay out. So this is essentially enabling all commerce transactions. So then you can think to yourself and even speculate that this allows companies to build in other countries and then pay in and pay out their employees, right? So they can even pay out their employees that work over there through DLocal's infrastructure in emerging markets. So now you're not only just getting DLocal's revenue growth, but now you're getting the revenue growth of the individual businesses in the emerging markets. And then you're also getting the GDP growth in the emerging markets because they're smaller. So like just how you ended up witnessing China just go through one of the craziest periods of growth and economic growth that we've ever seen any country ever do. Well, if DLocal was around and if DLocal was doing business in China, we would have seen that they would have been the infrastructure of choice because they would have been an emerging market player. And then they would have grown with all the companies that were in China or the international businesses doing business in China. So essentially, DLocal and GLBE are both they're my number one and number two positions. My conviction in those two companies is probably higher than most companies that even like the software giants that we all know and love, like Snowflake or Datadog or Zscaler, all those guys. But DLocal and GLBE are my highest conviction plays because of this idea of a more global commerce network. Both of them are plays on the globe being more interconnected, even on a transactional and a commerce perspective, an e-commerce perspective.
Fantastic secular trends. Like you said, just e-commerce and just globally connected commerce is one of those that you mentioned, and then kind of the continuous monitoring for app development, like you had mentioned earlier, for Datadog. Again, the companies that Dillon mentioned, Datadog, DDOG, DLocal, DLO, GLBE, GLBE. Some others you mentioned in the program too. Snowflake was mentioned as well, kind of staying away from Ford and MercadoLibre because of worries about debt. But Dillon, maybe one last question I have for you before we break here is how do you think about risk with these, right? We're looking in emerging markets, we're looking at things that are innovative, right? But they're still profitable and organic. We've certainly shown the things that you want to look for, rising margins, the secular trends and stuff like that. Is there anything that you would look at in an investment that would maybe you would consider to be a big risk that would be a turnoff? You say, maybe it's time for me to sell a position or reevaluate my thesis. What would be a red flag that you would see for something like this?
That's a wonderful question. I feel like we should probably talk more about that as investors, right? Is risk, and how do you define risk? So when I think about risk, I like to think about what Peter Lynch originally said, where he said that if you're batting 60%, you're doing great, right? So I'm not always trying to be right all the time. And I think that is what is one of the most important things of stock picking, is that when you do find your one company, and that one company really does become that multi-bagger over time, it recoups a lot of the losses that you've had from the losers over time. So if you have 10 stocks, ideally, you're thinking to yourself, like, let's just say you equally allocate $10,000 in each. You're running a $100,000 portfolio, right? You allocate $10,000 in 10 different businesses. And if you just left them alone, like let's say you do all your research great and you left it alone for the next 5 to 10 years, what you're basically going to get is you're going to get 2 or 3 major winners, right? And then you're going to get probably another 2 or 3, maybe 4, just moderate gainers. Maybe they get a couple 100%. And then you're going to get about 4 different duds. So you're going to basically see these companies, maybe they're going to be down 20, 30, 40, 50%, some of them 90%, whatever it might end up being. And the idea of this is that when we're trying to control risk, that's why I have that process, right? Is I just at least want to know that from a cash flow perspective and from a health perspective of the business, that's going to be healthy, right? So that's one area where I define that risk. And that's why I focus so much on the financial statements, is to increase my odds of success later on down the road. But when you're thinking about a lot of the e-commerce players, like I mentioned with GLBE and DLocal, obviously we're going to be in that wartime. So there's always going to be macroeconomic risks. Datadog, the risk right there that I can identify clearly is it's actually going to be their valuation. Because they're trading at such a high valuation, you essentially are banking on them here at the stock price. And they're not a full position of mine right now, to be perfectly clear, because of that valuation risk. I'm much more happy continuously adding to them over time after their earnings reports to continue to validate that thesis, because they're trading at like a 32 price to sales right now. And that's a risk, right? And I want to make sure that we're controlling that risk. Where DLocal and GLBE, their valuations are both compressed. I think DLocal is trading at like, so some people can say, yeah, it's trading expensive because it's 20 or 23 price to sales, whatever it might end up, but they have 40% EBITDA margins, right? And they're GAAP profitable and they have no debt on their balance sheet. They're worth every last portion of their valuation. Anyway, so like, let me simplify here. Datadog's risk is probably going to be competitive risks, and competition is always going to be a risk. And every investor should always think about competition, because that's one of the biggest risks. There's always going to be a different player, could be like even big tech, that gets into their space and just completely disrupts them. And then you even think about like the macro risks as far as the global e-commerce goes, like Russia and Ukraine. Like, how big does that war actually become? Is it going to become World War III? Because that's going to change the investment thesis all around, because it's going to be very difficult to close the borders of commerce if World War III is going on. So then in that particular case, I probably would sell both of them if more nations got involved. But as it stands here today, there's not a significant amount of risk in order for me to change my thesis as it stands here today. Then you're basically predicting the war, like what is really going to happen. In my theory, this is my investment thesis, as you would say. My investment thesis in this particular case is I believe that it will stay isolated to the region, because nobody wants the war to become bigger. So that's essentially how I'm defining risk in those 3 stocks specifically.
Makes a lot of sense, Dillon. Kind of recapping the approach, I like it. It's a good one. Look for the secular tailwinds that are out there. Look for the organic, profitable growth and the long-term business models that can capture that through long-term contracts. Once again, Dillon Valdez, at Blue Suit Dillon. If you want to follow him on Twitter, Dillon, I appreciate you being on our 7 Investing podcast here this afternoon.
Yeah, Simon, it was absolutely my pleasure, man. I appreciate you having me here and letting me talk stocks.
Absolutely. And also, we talked a lot about financial statements on the podcast today. Just a reminder for anyone who's listening that we are partnering with YCharts, and they offer some fantastic services for tracking financial statements, tracking metrics, like a lot of the things that we were talking about here on today's podcast. You can check them out at YCharts on Twitter or ycharts.com. They do offer a free trial to get started today. So thanks everybody for tuning in. This is another episode of our 7 Investing podcast. My name is Simon Erickson. We're here to empower you to invest in your future. We are 7 Investing.